Imagine you've been working on your small business idea for months. You've got the plan, you've got the passion, all you need is a loan to get things moving. So you walk into your bank, sit down with the loan officer, and they look at you and say, "Sorry, interest rates are really high right now. Borrowing is going to cost you a lot more than it did last year." You walk out empty handed, your dream on hold. But here's the thing, the bank didn't run out of money. So what actually happened? Right now, something very similar is playing out across major economies worldwide. Recent quarterly financial reports have shown governments issuing massive amounts of government bonds, sometimes called treasuries, to cover their budget deficits. Now, if that term sounds technical, here's all you need to know. A government bond is basically an IOU. The government borrows money from investors and promises to pay it back over time with interest. It's one of the main tools governments use to raise cash when they're spending more than they're collecting in taxes. And lately, they've been doing a whole lot of it. This is where a concept called the crowding out effect comes in. It's one of those economics ideas that sounds intimidating at first, but once you see the full picture, it actually makes a lot of sense. In simple terms, the crowding out effect is what happens when the government borrows so heavily from financial markets that it drives up interest rates, making it too expensive for private businesses and startups to borrow money. In other words, the government's appetite for cash ends up eating into the opportunities available to everyone else. Let's walk through how it works, step by step. Think of the financial system as having one big shared pool of money. Economists call this the loanable funds market. It's essentially all the savings and available capital sitting in banks and financial institutions, ready to be lent out to whoever needs it. Households saving for retirement, companies parking profits, foreign investors, they all contribute to this pool. And both governments and private businesses draw from that same pool whenever they want to borrow. Now, here's where the competition begins. When a government decides to run a large deficit, spending much more than it earns, it needs to borrow to make up the difference. It does this by flooding the market with government bonds and treasuries. Because governments are seen as very reliable borrowers, investors are happy to buy these bonds. But to attract enough buyers for such a large amount of debt, governments often have to offer higher interest rates on those bonds. That shift in rates doesn't stay contained, it ripples out across the entire loanable funds market. Banks and investors who could lend to businesses now see a better, safer return from government bonds, so they shift their money toward the government and away from private lending. The pool of available funds for everyone else shrinks, and the price of borrowing what's left goes up. To make this concrete, picture a small town with just one local bank. That bank has $1 million available to lend. Normally, 3 local businesses tap into those funds every single year. A bakery looking to grow, a tech startup chasing its next big hire, and a construction company that needs new equipment to stay competitive. It's a reliable rhythm. Everyone borrows, everyone builds, everyone moves forward. But this year, something changes. The government suddenly needs to borrow $800,000 to cover its budget deficit, so it issues government bonds at an attractive interest rate, safe, reliable, and backed by the full weight of the state. Hard to pass up. The bank, seeing a guaranteed return from a borrower that's never going to disappear, funnels most of its available funds straight toward those bonds. Now the math changes fast. Only $200,000 is left for everyone else. The bakery wanted $300,000 to open a second location. Can't do it. The startup needed $250,000 to hire engineers. Shelved. The construction firm wanted $200,000 for new equipment. They get the loan, but at a significantly higher interest rate than last year, which quietly eats into their margins and slows their plans. 3 businesses, 3 dreams, one crowded out market. That's not some abstract model. That's the crowding out effect doing exactly what it says. And this is precisely what economists mean when they say the government is squeezing out private investment. It's not a direct takeover. The government isn't physically preventing businesses from borrowing, but by dominating the credit markets with its own massive borrowing needs, it creates conditions where credit becomes scarce and expensive for everyone else. A startup that needed a manageable loan to launch now faces interest payments that make the math unworkable. A small business that wanted to buy new equipment or hire more staff quietly shelves those plans. Even large corporations start pulling back on expansion because the cost of financing no longer justifies the projected returns. And this isn't just a theoretical concern written in economics textbooks, it's happening right now. Those same recent financial reports showing record government bond issuances have also shown long-term interest rates climbing in response. Businesses across multiple sectors are already reporting that access to investment loans has become significantly more difficult and costly. The pipeline of new private projects is slowing. That's the crowding out effect unfolding in real time, in the real world. So here's the big takeaway. Government spending and borrowing aren't neutral acts. Every time a government borrows heavily, it steps into the same financial marketplace where businesses, entrepreneurs, and families are also trying to access money. When the government takes up more of that space, it leaves less room and higher costs for everyone else. The next time you see a headline about a government running a record deficit or issuing billions in new bonds, think beyond the politics. Ask yourself, who else is competing for that same pool of loanable funds? Because in economics, big government moves always cast a shadow, and sometimes that shadow falls squarely on the small business owner who just wanted a shot at making something real. That's the crowding out effect, and now you know exactly how it works. But here's a question worth sitting with. What if the government didn't borrow at all and instead cut spending to balance the budget? Would that free up more room for private businesses to grow and invest? Or could it trigger a whole different set of problems? Slower public services, reduced infrastructure, less support when the economy hits a rough patch? The answer, as with most things in economics, is it depends. On the size of the cuts, on the state of the economy, on how businesses and consumers respond. And that's exactly what makes this field so fascinating. There's rarely one lever to pull, and every decision comes with trade-offs that ripple further than you'd expect.